Well, thank you for joining me, man. I'm excited to have this conversation.
We've been talking about this for a while. So this is fun.
So quick intro on you, super high level. Obviously there's a lot to cover, but you run a business called Standard Communities, which you started in 2008. The portfolio today is massive. It's 27,000 units across 190 properties, 21 states, and 5 billion AUM, all in affordable housing?
Predominantly, yes, all affordable housing.
Okay. So I want to talk a little bit about your career curve, career arc, and then I want to talk about a couple deals that you brought up that I think would be fun to kind of deep dive into.
Totally.
How did you get into affordable housing?
I think I sort of fell into it, or it kind of found me.
Yeah.
So in college I was a philosophy major. So, like every philosophy major, the jobs in the philosophy factory were all full when I got out of school. So
Plato wasn't hiring.
Yeah, exactly. But I grew up in and around real estate. My father was in the industrial kind of office business for a little bit. He was in retail, like he had bought a little bit of real estate, had a lot of financial troubles with real estate, which kind of shaped my thinking about real estate and kind of the space. And I think, sometime around mid-college, the dot-com had, blown up, 2001-ish. And so, venture capital jobs and the hot, kind of jobs were, not in style. And so I decided that I thought real estate was the place I wanted to be. I had taken a couple classes in, real estate classes as well as, corporate finance classes, and met a professor when I was at Cal. He was on the board of a real estate company. And so I started, kind of basically working in real estate investment banking, when I came out of school. And I did that for a couple of years. And really, I was doing all sorts of deals. I was doing, apartments, industrial, hotels, office, everything. And, kind of just a masterclass on everything real estate. And it's probably the best job that you can get out of school. It was really
Investment banking.
It wasn't just investment banking. It was really pension fund advisory work within kind of that investment banking space. I say investment banking because we got merged effectively into Morgan Stanley, but it was the division I was in at the time, which was Lend-Lease Real Estate Investments, was a pension fund advisory shop. And so we had 30 clients that just wanted to buy real estate that we were advising. So they were constantly in buy mode. And my job was basically to analyze, different types of deals, put together packages, but you're just seeing the volume and different types of deals that people would do across different spaces. And so I had the ability to look and say like, oh, this is what I like about office. This is what I like about industrial. This is what I like about hotels. I got exposure to everything. And pretty quickly I kind of landed on apartments as like what I was really interested in. One, it was really tangible in terms of the people that you were helping and you were housing.
If you run a holding company or business with multiple entities, you should definitely listen to this. At Enduring Ventures, we have over 50 bank accounts across our different portfolio companies. Our director of finance, Nick, spends every morning going through those accounts one by one and making sure that the cash balance is where he expects it to be. This used to take him an hour or so every single day. There really wasn't an easier way to do it. Then a friend of mine introduced me to Vesto. Vesto makes it easy to connect all of your bank accounts into a simple dashboard. So you get real-time balances, transactions, and cash flow monitoring all in one place with just one login. So Nick got to go from checking 50 different accounts to just checking one account and one dashboard every single day. And a job that used to take Nick almost an hour every day now takes him just a couple minutes or less. If you're managing multiple bank accounts, Vesto is a no-brainer. Go to vesto.com, tell them that Sieva sent you, and you'll get to speak directly to the founder, Ben.
And two, I like the chaos theory of it. Like there was so many of them that it felt like they came together, in terms of chaos numbers. We talked about vacancy. It wasn't like you weren't talking about one particular resident or tenant. As an office building, one tenant blows out in the office building and can blow up the whole deal, right? You lose one tenant in an apartment community and, if it's sizable, doesn't make a huge difference.
Yeah.
And so
like the risk is kind of distributed.
Exactly. And oddly also a lot of the expenses, in most of the other property sectors, for some reason were not included in the numbers. They were mostly below the line. So I kind of started to notice like with an office building, you buy on something called net operating income. Below net operating income, you have CapEx, right? And everyone's buying off of this net operating income. In apartments, the turnover and CapEx you're spending on these buildings is all included in those numbers, and office and everything else, leasing commissions and tenant improvements were all below the line.
I didn't know that.
Yeah, and so it's super interesting. So I saw these large players that would buy these portfolios on leverage, and they'd take these hits from a CapEx standpoint here and there, when they would pop up, and it just scratching my head as someone who I had an entrepreneurial bent and wanting to buy some of these assets myself. I was like, why would I ever take on that risk? And so I drifted towards apartments. Seemed to be kind of the natural kind of way my career went. I started specializing in that, and then pretty quickly I started to understand that there was this whole other world within housing. Kind of affordable housing kind of ended up being something that I started really taking a big interest in. And again, it was this tie-in between being able to help people and do well while also, do well financially, because it really ultimately became what I understood to be kind of the largest public-private partnership that was out there. And, the government was investing hugely, especially as we started our company in 2007, 2008, in the great financial crisis. And so there was just tons of government money flowing in, and it seemed like the right place to be.
Did you get to apprentice on somebody, or did you get to follow someone as they did one of these affordable housing deals?
Yeah, so I really, I did banking / pension fund advisory work for a couple of years. Then I worked for a couple of guys in San Francisco and helped them start a platform. And we bought 15,000 apartment units from 2002 to 2006, 2007. Those guys were incredibly smart. Have tons of respect for them in the business, and one of them in particular, who'd been in the business for a long time, ended up being a real mentor for me, and learning from him, a lot of the, I wouldn't say affordable housing, but just how to run a business, how to manage a real estate portfolio as kind of an owner yourself versus just kind of working at a someone else's business, and additionally, I would say he really specialized in one particular type of affordable housing, which was something that was created pre-1986, something called tax-exempt bonds.
Okay.
And they were really using municipal bond work to buy and develop affordable housing.
Interesting.
And so that was kind of the first forerunner in call it 70s and 80s. And there was tons of that stuff. When I started in 2001, 2002, doing kind of banking, a lot of those deals were still around. A lot of those deals don't exist today, just given where the financing markets have gone. But I learned from him, he had a great kind of mousetrap in which he was, and they were both former brokers who knew the market really well. And so I learned kind of how to really suss the market, understand capital flows, and then they really kind of developed this specialty of understanding deals that had this tax-exempt bond financing on it and sellers who had no idea what they had. And there was this moment that the light went off, and there was just this information arbitrage, right? And I like I said, I came out at the time of the .com, so the internet was there, right? And these guys who I grew up with in the business had always told me about that deal we bought because I knew to show up at the courthouse steps in 1983 and no one else was there, and I bought it for pennies on the dollar. Yeah. And I was just this is never going to happen to me,
right?
Ever. No one's ever going to miss the courthouse steps anymore, right? Based on what's happening on the internet, right? And so it's where is your competitive edge, And then I saw these programs. I was like, people don't fully understand these programs. And so then I realized that there was this real edge to becoming an expert in these programs. And that, first was tax-exempt bonds, then it became tax credits, then it became subsidized housing, then it became mobile home parks, and it became, it was one thing after another of learning these nuanced, specialized businesses.
So you're working for this group, and at some point you're thinking to yourself, okay, I'm going to go out and start something else. Yeah. How did that kind of happen? Did you partner with someone? Did you just kind of make the jump?
That's a great question. I think, in most people in these situations, I wanted to stay where I was at. Two things were happening. One, I was in the Bay Area. I ultimately wanted to get back to Southern California, and I knew that in the back of my mind. I couldn't run a business that I was running up there and then move down and live in Southern California. So I knew something was going to happen there. I also, at the time, was having a lot of conversations with my best friend and now business partner, Scott Alter, who helps me run Standard Communities. And so we were talking about, what it would look like to start our own business. That was going on in the back of my head. And I was asking for more from these guys. And they drew a line in the sand and said, this is it. And so it kind of, someone draws a line, it forces you to make a decision. Right. So when they drew that line, I took, that's when I thought long and hard. And, I approached Scott and said, hey, I want to do this and I want to do it in Southern California. Let's go start our own thing. And that's what we did.
So you and Scott get together, you have kind of an inkling of an idea, and you're moving into a new territory. What did that first deal look like? Like, are you guys putting up a masthead and starting to call brokers, or like what was the path to finding and funding your first deal?
I mean, I'm sure the feeling, right? You put up your sign, you get all excited, you start the moment of like, hey, we started this business. And I think a month later, Lehman blew out.
Yeah. Good timing.
And so it was pretty much crickets.
Yeah.
And we sat for the first year, like literally sitting on our hands and knees.
Okay.
And sitting on our hands.
You're just burning through like capital.
We're just basically sitting there waiting and saying like, did we just make the biggest mistake of our lives? What are we thinking? We knew it was going to be bad. We didn't know it was going to be that bad, right? So it was like, we had this idea of starting a real estate company, capitalizing on a downturn. We're starting to conceive this in 2006-ish. We started in 2007 where we really form it, right? And then we actually go do it. And then the whole world goes, to hell in a handbasket. Right. And so we did nothing for a year. And we looked at the market. We spent a bunch of time. There was a brief period where there was a thought that Europe was decoupling with the US.
Okay.
And so we spent some time exploring stuff overseas. Scott and I spent, 6 months traveling. We had someone that I had done some deals with that owned a bunch of properties in the Czech Republic, and also was looking at some stuff in Ukraine, of all places. And so we spent some time over
my home country.
Some time over in Ukraine, down in Odessa and Kiev, and spent a bunch of time in Prague, kind of assessing the portfolio and opportunities we thought there. If the U.S. was going to continue to go down for a couple of years, should we look at housing opportunities over there? We ultimately passed on those for a number of reasons. And right about that time is when we got the first phone call back, which was we were bidding on distressed loans, because that's what you did, at that time, in terms of really trying to buy what we thought were the best, assets in the marketplace. Because we'd talk to sellers and we'd say, hey, we want to pay 30 for your property. They'd say, great, my loan's 50,
Mm-hmm.
I paid 70. And there just were no transactions to get done.
Right.
So we started approaching a bunch of different lenders.
Because then if you own the debt, then ultimately you could
ultimately get to the properties, and you'd like your basis in terms of where you're at on these deals.
Yeah.
And so we really started studying. The first area that we tried to kind of get really up to speed on in affordable housing at Standard was really the rent stabilized space. And that is, New York City, some of the, major LA City, some of the big
rent
cities.
stabilized at Section 8, or is it a
No,
different concept?
totally different.
Okay.
So it's rent control. So where there's, if you live in a city that typically has an older building.
Sure.
Okay,
so most of LA or San Francisco.
Most of LA, if it's pre-1977, is all going to be subject to some sort of rent stabilization ordinance. Some of them are more onerous than others. New York happens to be probably the most onerous in the country.
Okay.
It's gotten a lot more onerous since like when we, did a lot of the work that we did there. But the first deals we bid on were 2 rent stabilized properties in Harlem that were part of Washington Mutual that JP Morgan took over. I think there were $7-8 million of the loans, outstanding on the deals. The guy had paid maybe 15 for the assets. We bid 3.5,
Mm-hmm.
right? And they told us to go pound sand, and so we got a call, I think December, and we had done nothing all year, and get a call. We'd planned vacation, and we were both going down. Scott and I were both going down to Colombia, I remember, for like a buddy's bachelor party.
Mm-hmm.
And so we get a call on December, 20th.
Yeah.
Right. And JP Morgan calls up and says, hey, they're yours at your price if you can close by December 31st.
Love that phone call.
Right.
Bachelor party canceled.
So we actually divided and conquered. And so I said, Scott, I'll go to New York. You go down, hold, forward on the bachelor party, work from there, and we can tag team it and try and get it done.
Okay.
And so, I stayed back and, in New York. He went down to start. I went and joined later, the bachelor party towards the end, right before New Year's. But we stayed back and we got it done. And it's buying paper, so it was a lot faster and a quicker transaction. And we had, again, it was this idea of information arbitrage where we knew the receivers that were on the properties. We had a strong relationship with them. We had been talking to them about the deals, understood, kind of where we felt value was and felt like we were getting a deal we couldn't pass up. And most of the capital came from Scott and I on our first couple of deals and, put that together into those 2 deals. And that was then we were kind of off to the races. And then we could go to the second group and say, hey, look, we closed a loan. Yeah. You got to sell us more stuff.
Yeah, we're buyers.
Exactly.
Yeah, we're legit.
Exactly. So we had done, we closed, I don't know, maybe 20 loans or so, 25 loans in a period of 2 years once we were off to the races.
You guys put your foot on the gas.
Yeah, once it opened, it was like opened and then it shut. It was like a 1.5 2 year window to buy paper, which the Fed was forcing these banks to sell. And then they told them, don't sell. Okay. And then it was over.
They were selling mostly through brokers or bankers. Is that how these deals happened?
Some of it was direct, right? Where we had relationships with New York Community Bank. It was, and a lot of it was. We realized again this idea of this mortgage state versus deed of trust state. So every state is different, right, by law. So you have some states that use the old mortgage system, in which like if you played Monopoly, right, you get the mortgage on somebody's home. And they don't pay their loan, you come in, you say like, hey, I'm going to file an actual legal action in court, and I'm going to take that property through the court. You have a lot of newer states that adopted a deed of trust system in which they put they use a third-party trustee that holds this title. So when somebody doesn't pay their mortgage, the trustee kicks in and they auction off the sale and it goes super fast and it moves forward outside the court system. So California, for example, is a deed of trust state. If every mortgage for the most part is on a deed of trust. So if you don't pay your mortgage very quickly in 60, 90 days, that lender has access to be able to take that property. If you're in a state like New York or Illinois, some of the older states that are mortgage states, and you don't pay your mortgage, the lender files a foreclosure. It's 2 to 3 years of a legal process, and it's a court battle to go and take that property. And so we saw that, and so we really targeted those states because the lenders wanted to sell those loans because they knew they didn't want to hold these things in delinquency for 2-3 years on their books. And so that's really where we, first dove in. So a lot of our first properties were in New York, in Illinois, bought some in Washington, D.C. We bought a couple of deed of trust deals. We did some deals in Phoenix, Vegas, kind of some stuff that was, kind of really cyclical that we probably should have held on to, but we sold.
Yeah. And then you guys spent the next 2 or 3 years going through that court process?
Going through that court process, dealing with these guys. It was a really tiresome, cumbersome business, right? I mean, you're dealing with a lot of guys that the lenders were not selling any loans that they wanted to keep the relationship with the borrower. It was a relationship they wanted to end. And so typically you're dealing with a lot of guys who were playing games with lenders, they weren't truthful on a lot of things. I mean, I went to meet with one guy, he ran out the back door of an office here in LA. He saw us coming. You're dealing with stuff like that, right? And you're just trying to have a conversation. We were in these loans for, at prices that, it made sense to come to some sort of amicable resolution with these guys. And also, you're trying to look out for the tenants. I mean, most of these properties were falling in total disrepair, right? And if they didn't have money to pay their mortgage, they had no money to repair the buildings. And so the sooner we can get to the assets, the sooner we can protect the tenants and go in and start actually making, keeping these up to like an institutional caliber ownership. And a lot of times these guys just would want to bury their head in the sands and, they're dealing with, huge financial problems. And, we were one of those issues that were there at the time. And so, yeah.
How many units approximately was that? That was in Manhattan, the 3.5 million?
Yeah, we probably bought, that first property. Yeah, so the first property was probably like 65 units.
In Manhattan?
Yeah, in Harlem, yeah.
Oh, great. Oh, yeah, Harlem. Okay, so that was a good buy. That's kind of, in retrospect, I'm looking at that. I'm like, yeah, that's obvious.
Yeah.
Goodbye.
20 years later. It's funny, you say that in retrospect, right? But I remember sitting around and we were talking, the metrics in terms of rates of return that we're looking at. And we're like, God, we think at like, if we can buy at like a 7 to 8 cap, or, it's basically a 7 to 8% yield on these things, like that should be okay, and we were really on the fence. And every time, and this has been the history of doing this for 20 years, right? Like every time we come to that conclusion, we're always like 50 basis points higher than where the market is, right? So the market moves to 5, we're like, oh, we should buy 5.5, right? And it's like, sure enough, like the market goes back down to like 3. Right. And so we, didn't see that coming at all. But.
Yeah. So you're already pricing in like a margin of safety, but then the market has generally kind of reacted favorably.
Yeah. You've got in those deals, you've got to price a margin for safety on the returns, and you've got to price time. Like some of these deals took us 5 to 6 years on a couple of deals to get a hold of the assets.
Wow.
Yeah.
And that whole time, I guess
you've got a receiver in place who's like trying to run it, and you're trying to direct the receiver.
And you have to pay money for that, like for that to keep going, or it's a percentage?
No, so I mean, we bought all these things without any leverage on the loan side.
Okay.
Their loan continues to accrue kind of over time, so they owe more and more and more over time. And you get, if you're going to take the property, eventually you're getting that appreciation in that property. Okay. But no, you don't have to pay for the pleasure of going through the legal process.
Yeah, I can only imagine. What you mentioned that, over time there's been different kind of observations or perhaps mousetraps that you've observed in the government public-private partnerships.
Yeah.
Can you talk us through those different stages as that has kind of
progressed? No, totally. So that moment, like when that window closed on the loan side, was one of those huge moments. So we talked to all these banks that we're talking to on a daily, weekly basis, and all of them all of a sudden say like, we have no loans to sell anymore.
And are you like, oh shoot?
Yeah, we're like, where went to our whole business? Like we're finally getting kind of into like a groove. We're getting a reputation. We're starting to talk to some large institutions about partnering with us on these loans, and we've got a good resolution. We've made money on our first couple of deals, and so we talked to the banks, and they're like, we're not selling, and we're like, why? And they go, well, we just got TARP. I mean, we got, billions and billions of dollars are flowing into the banking system, and they've told us don't sell.
Right. We're rich. Right. Hold the assets.
Yeah, exactly. Yeah. So, and we're scratching our heads, and Scott and I are sitting around, and I remember we look at each other and we're like, well, if this is flowing into the banks, where else is this flowing? Mm-hmm. And so we started looking at all the places, and you actually get the legislation. And this is part of that information. You read the details of it, and you're like, wow, this is going in everywhere. It's not just banking. They did stuff in affordable housing. They did stuff in infrastructure. They did stuff in, and so we started looking at what other areas of housing, where this came in. And, there was direct money on buying low-income housing tax credits, because low-income housing tax credits were not selling. I mean, the market pre-2007, 50 to 60% of low-income housing tax credits were being bought by Fannie Mae and Freddie Mac, which are the big mortgage giants in our space. Financial crisis happens. Fannie and Freddie go into receivership. Yeah. Right. And the buyers of tax credits completely dries up. I mean, that market goes to nothing. That you cannot sell low-income housing tax credits, which are the main driver of affordable housing today. So
just talking through that for a moment to connect the dots. So somebody builds a low-income housing project. They get a certain amount of tax credits. They can go and sell that on some kind of open market. The company Fannie's buying those credits at maybe like some minor discount, let's say, and they're using those tax credits to offset their own profits, right? Is that loosely how it works? I'm thinking of like solar credits or something like that.
That's very similar to how it works.
Okay, got it. Yeah. So then like Fannie Mae's profits dry up for a little while, and they don't need to buy these. And because they're the biggest buyer, all of a sudden there's no longer money flowing to the developers.
It becomes even more complicated than that, because Fannie Mae and Freddie Mac, who own these credits, are supposed to be using tax credits, become literally owned by the government. Yeah. Right. And so now all of a sudden, if they were to buy tax credits, it's literally just a Ponzi scheme in which they're buying stuff for themselves. Yeah. And so they realize this, and they go to say, like, let's go sell all this stuff. Yeah. And so they're trying to sell it off all their books, but they can't sell it, because if anyone's going to pay them less than dollar for dollar for it, then the federal government's losing money, because they're literally taking $1 less to give somebody $1 tax credit, right? They might as well just take it and suck up the loss effectively. So they just go into complete stop mode, right? And it's the equivalent of like the solar business losing the solar tax credit. Yeah.
So all of a sudden, all the developers who are underwriting this tax credit being a piece of their cash flow, profit, whatever it is, it's just gone, poof.
Yes.
Then what happens?
A lot of nothingness for a couple of years.
Yeah.
And then TARP passes. Okay. And when TARP passes, the government says, you know what, developer, instead of taking these and selling these to, X, Y, and Z party to fuel your deals, you can turn them into the federal government and you can get 80 cents on the dollar. Mm-hmm. And the federal government will actually support and put in the equity to do your deals.
Got it. So they put together a pool of capital, basically, and they're like, this is a fund exclusively designed for the purchase of these tax credits. Okay, great. So we're back in business.
And so we're back in business.
Yeah.
And so all of a sudden we see this and we say like, okay, the business is restarting. It's coming back in and there's a floor put in place. Now the government stepped in at 80 cents, and how do we, if all this money was flowing into that, how do we actually go and capitalize a business on taking advantage of that? And so we kind of pivoted at that moment and said, look, we've been doing these loan deals. We've been kind of doing stuff that's resident friendly. Let's pivot the whole business to focusing on doing affordable housing. And that was, maybe 2011. And so 2011, we really started driving and saying, okay, let's become the developer of these deals and provider of affordable housing. And so our first two deals literally were in Illinois that we were the developer on. One was a senior project, about 105 units. One was a just normal family apartment, but had project-based Section 8 on the deal. So it had a government subsidy contract. And we took those deals and we financed them with tax credits and tax-exempt bonds, which I had learned about previously. And when we went in to do that, the state agency we were working with said, hey, by the way, we received all this money from the federal government on this tax credit exchange program. We have leftover money. We'd like to put in extra grant money into your two deals. Mm-hmm. And we're like, this is, this is exactly working out exactly how we thought it was going to work out.
Yeah.
And so we structured those deals at super low risk on the loan side. They supported those deals in trying to make them so they were, as low risk as possible, and easily facilitated getting those deals done. We closed those deals, and then we were kind of off to the races with those two deals.
Can you walk me through the details of the capitalization of those deals? I know you just kind of walked through it at a high level, but like the tax exempt bond piece, the grant funding,
how technical you want to get?
let's get pretty technical, and then I'll pull it up if it's too much. You know?
Right.
Yeah.
So
this is fun for me too. So I get to learn it along the way.
So the way we think about those deals is really on any deal that you're doing that you're providing tax credits on, the real requirement is that you have to spend a large amount on renovation. So that used to be a number on an apartment that was somewhere around $55,000 to $60,000 a unit. That number is going up. Today we're spending $85,000 a unit to, we have a project now we're looking at that's $180,000 a unit.
Wow. And the government, the city does that because they want a minimum standard of care for
the government set up the program originally to say this was really designed to have buildings that are owned for 10 years or more by the same owner. So you have to have this continuous chain of title, and you have to renovate and spend over X amount of dollars on a project in order to qualify for tax credits, right? And really what it is you're qualifying for tax-exempt bonds. And that was this precursor program from 1986 before they had tax credits, before everything else. So they had these tax-exempt bonds they used to do back when mortgage rates were 20% or 15%, right? And so tax-exempt bonds were a huge subsidy, right? Because if you're in a state that had a 50% tax bracket like California, a bank's willing to lend you at 7% versus 15%. It's huge, right?
Yeah.
Interest rates fall precipitously over the next 20 years. That subsidy becomes less and less, right? Mortgage rates are now at 6%. You being able to get a 3.5% mortgage it's good, but not as good as it used to be, right?
And the money flows, when you say tax-exempt bond, are you literally putting together a bond that people are buying directly into this building, or is it just selling through a local lender? Do you see what my question is?
Yeah. So you are getting a state approval for a federal subsidy to issue municipal bonds on that property, and then you are selling them to either however you want to sell them, to a private party, to a bank, to you could do a public issuance, you can do a private issuance, you can kind of sell it however you want. But whoever receives those bonds will be state and federal tax-free.
Okay, amazing. And that bond is like your loan? Is it the senior lender, or where does it sit in the
that loan is a senior lender on the property?
Okay.
Exactly. And so those loans are, going anywhere, a senior 70, 80%, of your capital stack.
Okay. So high loan to value.
So fairly high loan to value, but you're doing a massive renovation of the project. Yeah. And then what they did in 1986, and this goes just historically into the space, but you mentioned earlier, kind of Section 8 and project-based Section 8. So they had the most amount of housing that the country has ever built was in the period, 1970s up to like early 1980, right? And during that period, the government was handing out government subsidy contracts in which they were incentivizing builders to build in any location. You could go to them and say, hey, I'm going to go build. Government will say, hey, we'll pay everyone's rent effectively. They'll pay a percentage of their income, and then we'll also give you a mortgage to go with it. Those two things combined, every developer was willing to take risk.
Sure.
Right? Because even in Des Moines, Iowa, somebody's like, okay, I know the government's going to pay me $700. They're going to finance me. I'm all good to go. And so we produced millions of housing units per year.
Wow. I didn't know that.
Come 1980, Reagan comes in, this movement of power to the individual person says, hey, we're putting all these subsidies, really into the hands of like these building owners, and these, the residents don't have the choice of where to live, right? And they have to live in this, building that's being built here or there. We're going to give these people individual power. They're going to go live wherever they want. We're going to give them a voucher. And this voucher is going to be a Section 8 voucher, same name of the program, but they changed the program dramatically. And a lot of it was, there was a lot of graft associated with this program. They were building massive units everywhere, right? And so there was a lot of stories that developers were taking advantage of the program. And so he got a lot of flack for that. And then there was also this movement of like cutting federal spending, similar to an environment we're in now, right? Cutting federal spending, coming up with this unique idea of giving these individual vouchers to people. But when they did that, they killed the ability to finance these deals. And so starting in 1980, the amount of deals being developed that were using federal subsidy and just on a mass scale for affordable housing fell off a cliff. So come 1986, they pass tax reform, which is when huge changes in real estate occur. The passive versus active losses, where you used to be able to be a doctor, you used to be able to buy a building, and then your real estate income would offset your doctor income, so you didn't pay any tax.
Yep.
They end that in 1986, right? But they come back and they say, you know what, we've got to support housing. We're going to pass a low-income housing tax credit. That's going to be our answer. And so 1986 is the establishment of this low-income housing tax credit, which ever since 1986, that tax credit has been the largest producer of housing and affordable housing in the country since then.
Okay.
And so, I kind of rambling on the history of the stuff.
No, this is great.
I get super sucked
into
this. Geeking out on the history. But so,
because I guess just pulling out for a second, like I think what's interesting about this is that the government has a plan, right? And it has a variety of ways that it can like incentivize those plans. It can do taxes, it can do grants, it can do municipal bonds, et cetera. Yeah. And the connection here is like, how do you as an entrepreneurial investor connect the government's desires for a better country, which is really like the voters' desires for a better country, and use that in order to deliver what the government wants, what the people want, really.
Totally.
And they in turn will finance you, will de-risk you so that you can kind of build this portfolio. So that's why like I do think like the history is really interesting, and like the storyline's good. Yeah,
I mean, it really is. I mean, and there's a lot of parallels to today and kind of some of the major changes they're proposing and doing in the space today. But it really, they wanted to see major change. They went to a system that was, really the tax credits and the tax-exempt bonds were all privately placed, and there were individual companies buying them. And so it was that beginning of that more of, the public-private partnership that you'd see today in terms of private capital coming into the space and financing versus fully government subsidized housing that you saw from like post World War II up until like 1980. But they had this, tax-exempt bonds had been around for, a period of time in the 60s and 70s, right? And so they saw that and they're like, okay, let's rapidly expand that. So tax credits took that tax-exempt bond concept and really kicked that into hyperdrive with tax credits. And so your tax credits on these properties come by right with the tax-exempt bonds.
So you go to buy these properties. So you go to get a tax. These two properties.
You go to buy these two properties, and we go and say we're going to issue tax-exempt bonds.
Yeah.
The minute we get the tax-exempt bonds, the state agency is also giving you an allocation of tax credits that comes by right with it, right? And it's a set calculation. They tell you here's what it is, and in order to get those tax credits, you have to have either 10-year hold, or you have to and you have to do this substantial renovation. On top of that, if they want to encourage you to do this on federal housing, so if a property has substantial federal subsidy associated with it, then the 10-year hold rule is exempted.
Okay.
And then you just have to renovate the property. One of these properties happened to be this subsidized housing program, so it was included, and one of them was a senior deal that had been owned for 15 years by the seller, and so it qualified as well. And so we went to the state agency and said, look, we have a stream of cash flow that's coming off this asset. We plan to do a renovation for these residents. We'll leave it all in place. We don't want to raise the rents on the residents. Help us put together a program that works for them. They said, we can give you these, tax-exempt bonds. We can, and you're going to get tax credits associated with that. We then go to the private market. We then sell those tax-exempt bonds for our senior financing. And on the tax credit equity side, we go and bring on an investor who then invests in those tax credits and provides us the equity to be able to buy the project.
Got it. Okay, so the debt's coming from the bonds, the muni bonds, and then the equity is coming from you guys reselling the tax credits.
Okay. Yeah, and technically speaking, we're not selling them. They're actually an investor in the project.
Okay.
And they, technically speaking, they're an owner in the project to receive those tax credits, and they have to stay around for 10 or 15 years as owners of that project to receive those tax credits.
And they can be a company, could be Google, or they can be like an individual that needs to offset their
they don't work
profit.
really well for individuals for a number of reasons.
Okay.
It really needs to be a C corporation, and a widely held C corporation is typically you'd see.
Widely held, like a lot of shareholders?
A lot of sharebholders.
Interesting.
That's a technical IRS definition. But
Okay.
But yeah, so it'd be a widely held C corporation, and a lot of it, the biggest buyers are probably banks and insurance companies.
Okay, got it. Fascinating, really, really interesting. And that is your guys' first deal in this kind of new regime, basically.
Correct. Yeah. And I had done some of this with the guys that I worked with previously,
right?
And kind of had learned it, but it was the first deals that we did on our own. And to be honest, also we had no balance sheet, right? I mean, when we started the business, going and trying to do these, you're trying to apply for, one was a, $15 million loan, one was a $12 million loan, right? And we're going in trying to apply for these things. And there's rules of thumb that you're supposed to have liquidity,
right?
And you're supposed to have net worth to be able to, sign on the guarantees on these loans to be able to get this stuff done. And, it's where we utilized, a lot of the, kind of just the knowledge arbitrage, right, on some of the risk share programs or with the government agencies had lending programs that were associated with them that weren't looking for those guarantees and weren't looking for those, kind of balance sheet requirements. Yeah. And so we did our first deals under those programs in order to, and then once we were in business, it was like, okay, now we've done a couple deals. We've built up, a little bit of a balance sheet for those deals. We earned fees on those deals.
Yeah.
And so then we were off to the races.
Yeah, I was thinking about that. We were looking at a hotel where we had to do a construction because now that's part of our business. And, it's a meaningful loan, like tens of millions of dollars. And they're like, hey, like you're going to need to sign as a personal guarantee, not fully, but just to complete the project.
Yeah.
But we're going to want to see like a minimum of like X million dollars of net worth, X million dollars of liquidity. And I'm thinking to myself, like, how do people do this? How do they like get out of the gate? And I think that's like an elegant solution in your case to, it's some way you got to like zig to get to the level where somebody will give you a loan to do a bigger project.
I mean, the biggest thing I get approached by of junior people that are in the business that come is say, hey, I have this project. I want to do this project. I need you to sign on the loan with me. Yeah. Right. I'll give you 25%, 50% just to like participate and do this deal with me.
Yeah. How do you feel about that?
We've tried it a couple times. We've started to shy away from it a little bit. We'll make exceptions for, certain people. But it's really challenging. I mean, when we sign, going back, kind of to what you were saying, we don't sign recourse guarantees for the most part. I would say that, we've avoided them like the plague over the course of our career. Part of when I talk about my father, when I grew up in the business, my father signed a bunch of guarantees when he got into real estate, and in the early 90s, blew up. And so I lived through, my dad went through bankruptcy for 10 years, with lenders chasing guarantees and, trying to go through all that stuff. So
yeah,
I always swore to myself that like later when I made it in, kind of in business, I was not going to sign personally on guarantees. And so we've been very conservative over our use of the stroke of the pen. That being said, there's lender requirements of liquidity and net worth to do loans, and you have to establish that. And so most of the requests that we get that we'd consider would be places in which we are signing on loans that are not what you'd consider like just personal guaranteed loans, but they're loans that, are really framed in a certain aspect, like they're things we control. They call them non-recourse carve-outs. So they are things in which, bad boy actions, right? So we'll take those, guarantees and we'll provide the net worth and balance sheet on those. But, if we default on a single project, right, our entire business comes to a grinding halt. So we take, whether a loan is guaranteed or not guaranteed, we, for the most part, act like every loan we have is personally guaranteed, even though it might not be, right? And the issue that we've had with people approaching us and looking at those deals is that we have to watch them like they're in our portfolio. And at the end of the day, when we end up utilizing our whole team and watching those deals and putting a bunch of effort into it, a lot of times stepping in on those deals to fix issues or put out problems, we could have just done the deal ourselves. Right. Yeah. So like, why are we in the business of splitting that deal with somebody and having the complication of like, who's the quarterback, who's running the whole thing,
who's in control,
just ends up being, kind of more trouble than it's worth at the end of the day.
That makes a lot of sense. We were talking a little bit before. You shared with me a couple deals, and I want to just call out their names, and maybe you can tell me about one of them. One of them was Aspenwood, which is new construction, and the other one was Maple Point, which is acquisition and redevelopment. Could you walk us through one of those two deals?
Sure, absolutely. So Maple Point's a fun one. It's part of a portfolio. It was a 5-property portfolio that we bought in Illinois. Those were all subsidized housing. Maple Point, out of all of the deals of the 5 deals, Maple Point was the only deal that was not fully subsidized. It was only about half subsidized. And so we were competing to buy that deal. Everyone that was working on the deal had different plans for it. Again, this like information arbitrage was fully at play on this portfolio, in which we were planning a large scale renovation. Some of our competition was not. They just wanted to buy and hold and continue to own the properties. But to do the renovation, and we wanted to syndicate tax credits and do tax exempt bonds, we were under really severe pricing pressure, in which it was getting super competitive. There were multiple really, solid groups at the table, and we and part of our team, I got to credit our head of acquisitions at the time, Robert Kerner, who knew about another property that was giving up subsidy, and also from the city of Chicago, who wanted to take a certain amount of units and put them under a subsidy program. And so we knew about these different programs that were at play, and we knew that the rent levels of those programs were significantly higher than the rent levels that were at the property today from a financing standpoint. Nothing that would affect the residents. The residents would still pay the same rent across the board. And so we facilitated getting awarded the deals, tied the deals up. And then
you can bid a little bit higher.
We could bid a little bit higher, and we offered really aggressive terms, and also developed a really, again, a lot of this is people that, the sellers of these deals that own these deals for 30 years. Most of these, if they're subsidized, they were built probably in the 70s, right? So you're finding somebody who's owned this deal for maybe, in that case, 40 years, right? And they've lived with these assets. They were the original developers of the deals. And so who they leave these assets with is hugely important. And so a lot of it is like, we've been in the business now for 20, 25 years. I've been in the business, even longer in terms of just being in the business. And so you get to know these guys, and you get to know the sellers, and like, they know who you are, they know your reputation. And so I think a lot of it was about that. It's also about price. It's always about price. So it was price and while in contract, we went, and nobody knew. The seller didn't know, the brokers didn't know. We went and basically negotiated these separate contracts with the city of Chicago, and then also with this other owner who owned a subsidy contract they were trying to get rid of. And we moved it onto the deal while in contract, and then financed the whole thing. And by doing that, we're able to do a renovation that was, I think our renovation on that deal was about $110 10,000 a unit or so. And huge. That included huge. So it was these residents who'd been there, probably a lot of them living there for 20, 30 years, all mainly elderly. We're seeing new kitchens, bathrooms, new hallways, new roofs, new exterior cladding, new, kind of all the amenities areas got upgraded, everything, right? New building entry systems, new security systems, everything. And so it was really cool to see that all come together and to be able to do that while kind of in contract and add that sort of value. It was super fun.
You said you offered aggressive terms. Like, what are some terms that sellers are usually looking in these situations? And
so most of these situations to win these types of deals is usually they want to know somebody's done their homework ahead of time. So when we sign a contract with people, we're typically doing large amounts of non-refundable money.
Okay.
And so you're talking about millions of dollars of non-refundable deposits to secure these opportunities.
Wow. Yeah.
To put these together.
Okay. Skin in the game. People
skin in the game. They want to know that as they go through. The process takes 9 to 12 months a lot of times to get through this process, and so they want to know that someone's got a vested interest that they're going to go through this process and get it done. And that's what our reputation is, and we have to put money up, kind of behind it. And to be honest, it keeps a lot of it's the higher quality deals. It's been harder and put a little bit of a barrier around our business for new upstarts to be able to come into the space on some of these deals.
Do you think people bidding against you for that deal, they were also looking for kind of a 9-month lockup, or some of them were shorter?
Yeah, you have to on a lot of these deals because it takes that long to get approvals to just buy the real estate.
Got it.
And even if you're not planning on doing renovation.
This is the affordable housing world.
Correct.
I've only seen apartment buildings.
Yeah, so in the affordable
hotels.
Housing world, you're going to have regulatory agreements on most of these properties.
Yeah.
And all those regulatory agreements you have to go get approvals for. And so you're subject to that timeline. So at Standard Communities, we have 3 main values that we deal with. We act with urgency, we sweat the details, and we also act with kindness, right? And so as we come in this act with urgency, where we bring that into doing these deals in the acquisition mode, is the fact that there's a lot of stuff that has to happen to facilitate a tax credit deal, for example, right? A lot of times we do that while a lot of these other things are happening, and we move with urgency, right, on it, and more so than most of our competitors.
I mean, I can't imagine the stress of that deal, right? So you're going under contract, you're putting a multi-million-dollar deposit, and then I assume at the end of like 12 months or 9 months or whatever, the contract expires and they keep your money unless you can close. It's probably looks something like that.
100% exactly like that.
Okay, so you are sprinting because if you can't get the city to agree for these higher rents and for this development budget, then the project perhaps no longer makes sense for you guys. So you have to kind of land the plane from all directions in that 9-month period in order to effectuate the deal, or you lose millions of dollars.
Well said.
Yeah.
So
scary.
I think that when we started and when we did some of those deals, that deal was probably 8-9 years ago.
Yeah.
We had to take a lot of risks when we started the business. And there were certain deals that we did that on. Today we have the balance sheet and we've built up the business to be able to backstop, if a deal like that was to fall through for some reason we couldn't get approvals, like we would just buy it.
Yeah.
And then we would deal with it after closing.
Got it.
At that time, we didn't have that balance sheet, didn't have that ability to do that. And so we had to thread that needle and land that plane. I remember, a similar deal we bought was about $110 million deal we bought in the center of Manhattan. That was a subsidized deal that we needed to get certain rents approved from HUD in order to buy the deal. The seller, just given New York and them being a New York real estate owner, and this was in the meatpacking district, on basically 8th Avenue and 48th Street, right? Prime Manhattan, 150 units, subsidized housing, really cool building, and they wanted close to a $10 million deposit, right? So we put up a $10 million deposit,
wow,
which was huge money for Scott and I at the time.
Yeah,
and we knew we had 9 months to get it done, and HUD came back midway through the process and said we have an issue on the rents. Right. And we were, and I remember because I was having my first child who's now, about to turn 8.
Yeah.
Right. And my wife was basically it was like on a Friday we got that call, and I said to her, I said, please, whatever you do, just don't go into labor. I need to be on this call with HUD like Monday morning. Like it's like our whole deposit's riding on this thing.
Yes.
And I got to know what happens, right? Of course, her water breaks on Sunday night.
Yep.
Right. And it's like we're up all night on Sunday delivering. It's a 20-hour labor going through the whole process.
Oh my God.
I mean, she's in it, and and I'm like. And I'm being there as best I can, trying to tune it out. And I'm just like, Scott, you got to deal with it and take the phone call with HUD and let me know how it goes.
Yeah.
And so luckily, like midday, like on Monday at some point, I got some break where I stepped in the hallway, I looked at my phone, and he's like, I think we're making some traction.
Yeah. Scott was just begging on the phone,
and
groveling.
It wasn't begging. It was like, it was a technical, really kind of reading of the way that they saw the program.
Yeah.
And we felt they were in the wrong.
Yeah.
And we pointed it out to them, and they concurred.
Yeah.
At the end of the day, and so we got them there, and then we got the deal closed. But there was not a lot of room in landing that plane. I mean, if we didn't get those rents, it was blowing up that deal.
Have you ever lost on one of those deals where you have to put real money down and you're not able to pull together? Because so much of this is like you're reliant on third parties. So even if like you guys do all your work in 15 days or 30 days, like you can wait 6 months for a city to respond, you know?
We have walked away from due diligence costs. We have not, when we put down deposit money, we've gotten it done every time.
Mm-hmm. Wow. What is your relationship like with Scott? What are your personalities? It sounds like certainly some amount of risk on is there, but how do you guys push and pull in order?
Yeah, it's super fun. I mean, we've been at it for almost 20 years together now, and it becomes kind of like a work marriage, at some point.
Sure.
and we're best friends, and we talk probably. It's probably the best part of being able to run the business that we run is the fact that you don't have to do it alone. Mm-hmm. Like if I got all these phone calls and I'd make all these decisions all by myself, I mean, it'd be a whole different world. I'd probably be a lot more bitter.
Yeah.
But we have a lot of fun with it, and we play off each other, in which it's like almost to the point now where we just know it's going to happen. If one person goes, zigs one way, the other person zags, right? Mm-hmm. So if I'm nervous, he's like super aggressive. Mm-hmm. If he's nervous, or if he's, nervous, I'm super aggressive. Like we always play off the opposite on particular deals. Yeah. That's kind of been our relationship. I think that when we first started, he was much more in the details than I was. Had a little bit more of a history with kind of on the institutional capital side. And I had more of a kind of a deal general partner background. And so we still kind of play to those roles, if we're dealing with various capital partners. Scott, a lot of times we'll kind of step in on some of that stuff. If we're on the deal side and dealing with kind of crisis mode on a particular deal, a lot of times I get more involved.
Mm-hmm. Operational
type stuff, et cetera. So, honestly, at this point, like if one of us is not in the room, like I pretty much know what he's going to say and he knows what I'm going to say. Mm-hmm. So it's like, we are able to leverage a lot of our time. We both are raising young kids, right? I've got 4 young kids. He's got 3 young kids. And so time has been like our most precious resource. And so him being in New York and me being in LA, we both started in LA, but now he's in New York. And, the morning hours, like, he's able to cover for me on certain things in the morning while I'm dropping kids off at school, et cetera, right? And,
he's in New York?
He's in New York.
Okay.
And so he's able to cover for me in the morning hours. Yeah. And the evening hours, same thing. Or if I take a week off for the kids and I'm like, Scott, you deal with it, let me know. And especially now with AI, like I get all the notes from like all the calls and I can read everything, catch up. And, and he's got power of the pen for me and it's vice versa.
So you guys have like a Fathom note taker in all of your meetings?
We do now.
Okay.
Now, for
that's
sure.
Great.
But that's new.
Yeah.
We've been trying for a while.
We should do that.
It's getting better. Like I'm trying to, my like secret, super non-sophisticated, and I'm not great at tech, but my dream is to have, like, we're using Otter AI for a lot of stuff. We use Teams on the recordings from Teams. Mm-hmm. And then I'm having my assistant put it into ChatGPT and create projects. So I have like we have basically different business lines within Standard, right? And so on those different business lines, we have recurring meetings. And those meetings just get dumped into ChatGPT every week. Mm-hmm. And so rather than me having to go back and look at the notes, I can now go in on my phone and query and say, like, tell me the goals that have come out of the last like 10 meetings.
Yeah.
Like, where are we headed? You know, what are these, what do I need to look out for in the next meeting?
Yeah.
Et cetera. So while I'm sitting live in a meeting, I can kind of pull up reference points of all the meetings previously, and it's great. It's awesome. It's
magic.
So it's just starting to work. But
okay. I think I got to introduce AI
data
into all of our internal meetings. I like that.
It's a huge priority for us.
Right now, it's just like each individual kind of has their little like AI guy, but we're not centralizing, and I like the centralizing concept.
It's I think that it is a huge driver of the business, and like when I talk about chaos theory in the beginning, right? Like, chaos theory basically thrives on data.
What's chaos theory?
Chaos theory is basically where it doesn't, it looks like chaos when you look at it up close.
Yeah.
And then you zoom out and you have enough of it. Like, it's like sand on the beach, right? Yeah. Like, you look at a couple specks of sand and it's like these grains, and then you zoom out and all of a sudden you have like a beach.
Yes.
Right. Yeah. And so like that to me is like the apartment business, 30,000 units, 50,000. Our goal is to get to 50,000 units by 2030.
Yeah.
Right. And we're on track for that. And when you zoom out and you look at 50,000 units, you can't manage like saying like, oh, I really, what's going on in that deal? What's going on in that deal? Right. You need to have access to data.
Right.
And it's like our business is becoming so much about the data.
Mm-hmm.
And so investing the AI side is all about the data as well, and just harnessing that and being able to leverage access to the data. And so that's become kind of one of our number one priorities right now, is like how we get better access to data as we scale. And AI is just right at the center of that.
You guys have gotten pretty big now. Do you have like a team of investors, or is it just still you and Scott as far as like the kind of MD or MP type decision makers?
Yeah, so it depends on the deal, and we have different business verticals. Yeah. So we have, we have at Standard Communities, we have our new development division. The new development division is just really Scott and I.
Mm-hmm.
So
looking for land to develop ground up usually.
Correct.
Yeah.
And we're bringing in tax credit investors, but we're the sole GPs, sole decision makers on moving those deals forward. And then we have what's called an acquisition renovation group. We call it AC Rehab. That's where we're doing that same tax credit model on existing buildings that are older, kind of like the Maple House, that deal that we just went through. So similar deals to that. We're doing, call it 15 of those deals a year. Those deals are all Scott and I as well.
Okay.
Then we have
and then there's some sort of BD function that's like sourcing the deals, kind of like
each of those
taking them up through
divisions,
analysts.
Each one of those divisions is solely basically independent in that regard.
Yeah.
So development has a whole sourcing apparatus involved with development. We have the AC Rehab guys have a whole sourcing apparatus with AC Rehab. And then we have a group called Essential Housing. And Essential Housing is a group in which we are opportunistically investing equity into all aspects of the housing space. Some of that is Scott and I. Some of that has become institutional investors. Some of it has been friends that we've passed the hat to over the years that have invested with us, that
it's
have been
a fund
with us for a long time.
There's a fund associated with it?
We have done funds.
Yeah.
We do not have a fund at the moment. Most of what we're doing at the moment has been our own individual capital.
And so somebody comes to you with an apartment project, and you think you're just underwriting it almost like a limited partner, basically.
Correct.
Okay, got it.
So we have different needs at different times, right? So sometimes we're looking and we're selling certain properties, and we have needs for 1031 exchanges.
Oh, yeah.
At different times, Scott and I are looking to place equity from the company. At other times, if we're looking at large portfolios, we'll bring in institutional capital partners. And so we're pretty nimble on each transaction. And given our ability now to take down deals ourselves, it gives us a lot of ability to tie up opportunities and then decide what we think is, whether we want to buy it, whether we want to bring in a partner, whether we want to, kind of what the most optimal execution is.
Yeah. How have you built up kind of some senior level infrastructure in your team in order to deal with all these projects? It seems like there's a lot going on for Jeff and Scott.
Yeah, no.
And I'm actually surprised to hear that you're the one that's going to see the 30 projects in Southern California today.
Yeah, I mean, it's a multi-billion-dollar deal, so they want to know that someone's seen it. But yes, I am not the one.
You're not going to the 50 unit apartment building.
I'm not going to usually see a lot of the assets on a first go. But really we've set up we have a great team in place. So we're approaching about 130 people that are in the corporate office, nothing to do with property management. And I would say that each one of those divisions has AC Rehab probably has the most, has 40 or 50 people in it. New development has about 15 people or so. Essential housing is about 15, and then we have a lot of support staff, whether it's accounting. We have in-house legal. We also have a lot of verticals in which we have our own in-house GC, own architecture company, own compliance company. So we have a lot of different resources to draw on as we're looking at different opportunities that I think makes us unique.
Interesting.
But the sourcing is obviously the tip of the spear and kind of where it all kind of comes in. And I think that what we found the biggest success of is that Scott and I have certain relationships that we've maintained over the years. We just noticed with brokers, and you probably notice the same thing on your stuff, like brokers have a tendency to have, it's a personal relationship more than it is just a business relationship.
Sure.
And so to try and offload those to junior team members or people coming up is really difficult.
Yeah.
So we end up keeping a lot of those personal relationships, and then we have the team in place that's looking at a lot of the opportunities and chasing down and running a lot of the analytics and details, and then processing deals and moving them through completion.
Okay.
And we've invested a lot in our leadership development and kind of training and developing teams. And so, in each one of those groups, we're really trying to identify who are our next, generation talent and leaders, and then how do we provide training to them? How do we get them to continue to move up in those roles? And luckily, with all the growth that we've had, we have a ton of opportunities for people to take on new opportunities and grow the business. So a lot of our people have been with us for 10, 15 years, over the years. And we have a couple people that have retired, already with us, and, are able, fortunately, have participated in some of the deals and are able to live a comfortable retirement.
How do you think about aligning people's incentives with kind of like the performance that you're looking for, whether they're sourcing or whether I don't know if it's like performance in the deal.
Yeah,
how does that
it's a
all
really
look
good
like?
question.
Yeah.
We spent a lot of time today on performance and line compensation. And I think that, I think it all starts with the goals. So we spent a lot of time on goal setting with the teams. And it starts with Scott and I. So this was the first year that we identified our 5-year goals, our 3-year goals, and our 1-year goals. Mm-hmm. And then tried to filter that down to all the individual teams and then all the individual team members. So everyone throughout the entire company now has goals. We made them transparent to everybody so everybody can kind of see what their goals are across the board. And then in order to have a incentive aligned compensation package that ties to goals, people need to be really clear on those goals, and there needs to be constant feedback on those goals. So we're trying to create something on a quarterly basis where we have, we're using a tech system these days called 15.5, okay, which is basically a goal setting software system. And then people are putting in quarterly updates to tell people, are you on track? Are you behind? Are you going? So at the end of the year, the biggest mistake I think you can make, and we've seen it happen, we've been guilty of it at times, where you have incentive-based compensation, you get to the end of the year and somebody says, I thought I did great. Yeah. And you're sitting there telling them, we think you miserably failed. Yeah. Right. And so we want there to be no surprises on the compensation guidance as well as, those numbers. And so we spent a lot of time kind of putting that together. And so I think that on the acquisition side, you're going to have guys that are tied to acquisition related goals. We've got and KPIs associated with that. And then you've got, kind of more back of the house functions in which we even have some functions like our in-house legal team that part of their compensation is based on how they're rated by other groups. Mm-hmm. Do other groups, enjoy working with them? Are they helping facilitate their transactions, et cetera? Oh man, I need that at some of our companies. How good are you at working with us as investors? Are you responding to my email or not? You and I share this in common, like besides our affordable housing platform, Scott and I have also, been investing in other platforms as well. And so it's been interesting to see, development and working and we are, kind of call it, kind of owners of various other businesses. And those other businesses, like you're saying, where we're more of an LP in those positions, mm-hmm. But in the business unit and seeing the communication and kind of the, kind of needs of those businesses compared to something that you're like doing yourself is different. And there's only so much control you have. At the end of the day. Yeah, we have a couple wonderful businesses where I'm like, hey, you haven't responded to my team in like a week. What's going on here? And then other ones who like respond immediately. So it's interesting to see like the variance in communication. And
there's actually not a direct correlation to kind of like growth or profitability, because even, some of the bad ones are like the poor communicators are growing really fast.
I was going to say, like, sometimes you have guys who don't really want to communicate because they're like, I got it handled.
That's right.
And like, don't worry about it. I'll call you when there's a problem.
Yes. Yeah. And I try not to be like like I have very limited value that I can add, and I'm like very confident in that statement. So I try not to be like the person who's like parachuting in. They call it like being a seagull. Have you ever heard of that?
Oh, absolutely.
Yeah, you fly by, you like shit on everyone, you fly away.
Yeah, exactly. Our biggest thing, I think, is FaceTime with people. And time is a big resource, but I don't know for you, but like for us, it's always like trying to prioritize getting together, breaking bread with people, versus like the investor updates and getting on the formal calls and like those sort of stuff. I mean, I think it's really about building the relationship first. That's a good thing to remember for sure. Because sometimes I get lazy about that. Totally.
Like, I don't want to fly across the country.
Exactly. It's like, tell me how we did this quarter. And it's like, and Scott's really good about that. He's always like, we got to sit down with people. We got to get together. And we do it, and everyone just feels better. And it's like, it's much easier.
Agreed. I definitely recognize that. So I guess the last kind of question that I want to ask you, or maybe it's a two-part question, is one, what do you feel like we didn't cover that you think would be interesting to talk about?
Yeah.
Or two, like, what do you think would be interesting for somebody who's the young Jeff, who's like just coming up in their career, and would be helpful for them to know?
Sure. Why don't we can cover the second one first?
Yeah.
So I think that, I tell a lot of kids who are coming out of school, I think when it comes to real estate investing in particular, I think it's if you want to go out and do it on your own and run your own business, you need several things. One, you need a base education, right? You got to work somewhere where someone teaches you the ropes, right? It's hard to work for some smaller company in real estate and get a real idea of what's happening. It just, your view becomes so insulated in terms of the way you view the world. Mm-hmm. And so I really encourage everybody to try and get a job that is similar to like what I had, whether it was in banking or pension advisory work or some larger business, to understand the analytics behind it and kind of the way institutional investors look at the world. Now it's like tons of private equity companies, et cetera. You need to work somewhere at some point where you get a mentor who's an entrepreneur, who thinks like an entrepreneur. I mean, I don't think we would have survived going through a lot of the lawsuits in a lot of these loans that we bought and going through that process had it not been with somebody who, was really knowledgeable in litigation.
This is your partner, or this is the mentor?
This is the mentor that I had.
Right? Oh, wow. So you would call him and say, hey, like, we're stuck.
No, I learned from, at that time I didn't call him, but I had learned, like, he was involved in tons of litigation at different times and wasn't scared of it, and like understood that, real estate sometimes is just entirely a leverage game of who can push the other person around. And not being scared to kind of get in there and kind of, make some tackles and, and stay on the field. And I think that like I learned a lot of that from him. And then also just the way that he looked at deals was a big thing that I learned. And then when we started our business, going out on my own wasn't such a big step, right? And I think a lot of people miss in our business, they think they're going to go buy a bunch of assets. They're probably pretty good deal guys. Like they might understand, how to source deals and whatnot. I think what they don't realize is that, ultimately in building a business, you're going to do 3 or 4 deals. You're going to usually get paid some sort of promoted interest on those deals. Like, how do you live after 5 deals and scale a business over time? Mm-hmm. And unless you've seen somebody who's like really run a business and run a successful real estate business over time, like it's hard to like understand that until you get 5 deals in and you're like, okay, what do I do now? Right. And then you learn it through the school of hard knocks, but I think it's much easier to scale a business faster having that experience. And then also understand that real estate is I think a lot of people today think of real estate as just an asset class, similar to like, you're just investing in private equity, you're going to buy it, you're going to own it. What's your unique skill set? Like, what are you doing, right? Like there's reasons that there are real estate brokers, there's real estate property management companies, there's, real estate developers, right? Like, what are you actually doing to add value to that piece of real estate other than just like buying it, right? And if you're just going to source deals and buy deals, it's great, but if you don't have a lot of capital to start with, it's hard to make that work over time, right? I mean, if you're starting and you inherited $1 billion, like it's a great business, right? If you are starting with nothing and trying to grow a real net worth, you're going to be waiting a long time for that to come to fruition. And there's going to be a lot of people that are going to take chunks out of your pocket in terms of capital that you need to raise from other people and, et cetera. And so then it becomes, I think, I would pick something that you become an expert in. For us, that happened to be affordable housing and also development. And we've grown to now be able to include general contracting and architecture and like other aspects of that business. But that's what allows us to have our competitive advantage and edge in the business. And I think that a lot of young people don't realize. They just think, oh, we're just going to buy some deals.
Yeah. So maybe I'm going to try to summarize that and you can kind of correct me where I missed it.
Good.
So
ChatGPT version.
Yeah. Sieva GPT. So first is find an opportunity to go wide, right? So to really like expand your purview across different asset classes. Second, I think find a mentor, but not just any mentor, someone who's entrepreneurial with experience, who's kind of like been through the business building themselves. And then third, it seems like, especially if you're starting out from zero, which is where you were starting out, or maybe you have a little bit of savings, but you don't have a ton of capital. If you want to get off the ground in real estate, you really have to create value, right? You can't just step into something that's already fully stabilized. You need to see an asset, maybe find some construction element. Maybe it's a ground up, maybe it's affordable housing, et cetera. Did I miss anything?
I think that's right. Okay. Totally.
Cool. Anything else you want to talk about?
I mean, I think, the only thing I would say is like today, I think I hear a lot of concern and worry today about the new administration and cuts in affordable housing and like where the industry's going. And I think that, having I've spent some time in DC over the last, several months, and I'm actually really excited about the prospects of the business. And I think that, they're looking for efficiencies, and I think there definitely are efficiencies. I mean, anyone who looks at government can probably see plenty of efficiencies that are out there.
Yeah.
And so I think we welcome that, and we think that's a good thing.
Okay.
And I think that, again, like, I think it's about speed and execution. And I think they're trying to deliver that more. Yeah. And so generally speaking, I'm really bullish on the business over the next several years. I think that right now in apartments, similar to commodity pricing, right? Like, and we've seen it through different cycles. When they don't build, it's a good time to be in apartments, right? And building has come to a screeching halt for a number of reasons. And so the fundamentals right now for apartments are really strong in terms of rent growth over time. And also, average median incomes. I think, there's about to be legislation probably on tip earners, not paying taxes. There's a lot of, I think, movement of a lot of the people that we house of continuing to see, kind of continued wage growth in, hourly jobs, et cetera, with federal minimum wage, et cetera. So I think it's a good time to be in the space.
If you could whisper any messages into the ears of our legislators, what are some like hopes or dreams or guidance that you would have for them as somebody who's kind of on the ground?
Yeah, that's a good question. I think that the thing I would say, every time is that I think that it's a really hard business and complicated business to start with, of assembling all the pieces that we have to put together to build these deals and to develop affordable housing. And a lot of local municipalities have a tendency to add a lot of things onto it. So you'll see a lot of cities in particular will say, oh, like we need to have this requirement or this requirement to build housing. And it's like, it's hard enough. Like we don't need to make it any harder. Yeah. And so I would hope that some of the cities start to learn that housing production is more important than some of the requirements that they're adding on to these deals that are kind of their wish lists for building housing. Yeah,
I can't imagine, as somebody who grew up in San Francisco or lives in LA, I've only at a very high level seen how painful it is to develop housing here and how much it is needed, frankly. So
yeah, I mean, the most efficient developer of housing in the country, bar none, is the home builder. Right? I mean, Pulte Homes, Coffin and Broads, you've got, D.R. Horton, right? They're building hundreds of thousands of homes every year.
Yeah.
Right? I mean, it's like they're not short on building homes.
Yeah.
And then where are they doing that? Are they doing it inside the cities? No. They're doing it outside in the suburbs on the outside, right? And so the question, if I'm a city, is like, how do I leverage off that? How do I really capitalize on how they're able to build at such cheap cost and at such mass production, and how do we develop programs that incentivize that to happen versus the way it works a lot of times within cities right now is like, oh, we have this weird site that's over around the corner and we think it would be great for affordable housing, and it's like 7 stories and super complicated and super unique, and you're never going to replicate that across more sites in the city. We want you to spend 4 years trying to get that done. That's typically the model. And I think if more cities kind of woke up, and I think certain jurisdictions like Florida's done a really good job at this in terms of their sprawl planning and how you incorporate that and how you kind of build at lower cost to be able to develop housing on a continual scale. I think we could learn a lot.
Okay. Awesome, Jeff. Well, this is great. I appreciate you taking the time. And
no, thank you.
Congrats on everything you've built, man. It's so cool.
Thank you.
If there's ways that people want to get in touch or kind of follow you, is there a way for folks to do that, or what's the best way to connect?
Yeah, I'm on LinkedIn.
Okay.
So you can follow me on LinkedIn. And then our website, we have a pretty good presence at standardcommunities.com.
Okay.
And so I encourage them to reach out, through there. And also you can always call our office and try and get a hold of me.
Nice. That's awesome, man. I might call your office.
You should.
Thanks.